Okay, so Dave has basically ended his hosting session, so I'm taking over. The next panel will be called Risky Business, Balancing Financial and Technical Risks in Stablecoin Protocols, with our moderator, Jack Sanford from Sherlock, followed by our panelists, Omer Goldberg from Chaos Labs, Ivan Kozlov, Resolv Labs, Marcin from RedStone Oracles, and Michael from Open Zeppelin. Welcome our speakers, everyone.
Hey everybody, thanks for joining. I'm Jack Sanford, CEO and co-founder of Sherlock. Sherlock does smart contract audits, smart contract insurance. Today we've got a great panel. We were just talking about yield. Now we get to talk about the risks of yield and stablecoins. We've got a great panel here, so let me just pull up some of the questions. We have Omer Goldberg from Chaos Labs, founder of Chaos Labs with us. We have next Marcin from RedStone Oracles. I'm not going to try to pronounce your last name. I'm sorry.
Kazmierczak.
Kazmierczak. Okay, nice. Next, we have Ivan Kozlov of Resolv Labs, co-founder of Resolv Labs, and Michael Lewellen, head of solutions architecture at Open Zeppelin on the far side of the couch. So to kick things off, we're going to talk about all different kinds of risks associated with stablecoins today, from Oracle risk to smart contract risk to economic risk, and we have a great panel to do that. So let's kick it off and start all the way at the end of the couch with Michael. And Michael, what do you think about the smart contract related risks associated with stablecoin protocols? What are the main ones? What are the gotchas? What do you see from your vantage point?
I think starting out, it's usually an underappreciated aspect of stablecoins. We think of stablecoins as being like what should be some of the easiest primitives, because in reality they're usually just a ERC20 token. But deceptively, there's usually a lot of things that any protocol that's listing them, whether it's like a DeFi protocol or even a centralized exchange, has to consider. We've worked with both Coinbase and Compound Finance on like trying to figure out the listing risks. The first one is just like, is it actually ERC20 compliant? Like one of the most popular stablecoins, Tether, is actually not fully ERC20 compliant. There are some like transfer functions that don't actually return values you would otherwise expect. So like Compounds, for example, had to do like special custom integrations just to list it. And then on top of that, you have like some new stablecoin models like Mountain Protocol that are rebasing. And I'm sure, I think we have later discussions in the panel for that. And then you also have cases where, like a stablecoin has just something very weird they've introduced. We've actually had like a issue with TrueUSD listed on Compound that introduced a double entry point, and that could have led to an $80 million exploit. And it's something that the protocol like spent a lot of time when they were first listing TrueUSD looking at all the like risks surrounding the liquidity and the like the typical financial risks you would look at, but not really technical risks. So it's something that we see a lot. Again, 90% of the time it's fine, but every once in a while you find something that's a little weird and a little unexpected, and so it's always something you have to check, even if most of the time the answer is hopefully it's a normal ERC20 token and something you would expect to behave normally. But yeah, there's something to look out for. And I guess the last thing is hoping that whoever maintains a stablecoin, whether it's upgrades or blacklisting, whatever, is going to maintain that safely. I don't think we've ever seen a major stablecoin provider lose access to the keys used for those sorts of sensitive functions, but that's a black swan event that I think we also kind of underappreciate at times. We just trust that the major stablecoin providers are going to manage those keys securely. They have so far, but at the end of the day, we are trusting that they continue to do so.
Awesome. Ivan, I'm going to come to you last since you're the stablecoin protocol builder on this panel. And let's go to Marcin next. What do you see as the main Oracle-related risks that associated with stablecoin protocols?
Yeah, so hope everyone is still alive. I know it's very hot outside, but we hear the AC is working pretty well. So Marcin, co-founded RedStone. We are one of the quickest growing Oracle right now in the market, providing both the push and the pull Oracle model across over 60 chains right now. In terms of stablecoins specifically, there are a couple of verticals. So first, we really need to remind ourselves that there are different types of stablecoins, like the, let's call them regular stablecoins, so fiat-backed, like Tether, Circle, and so on. Then you have CDP stablecoins, collateralized debt position stablecoins, like MakerDAO, DAI, or now it's called Sky and USDS, like the big rebrand, or Liquidity. In terms of oracles, one is to price the stablecoin. So some protocols prefer to deem a stablecoin is worth $1. So for example, I think in Compound, it's still the case that they deem one USDC $1, which on one...
Only in V2, but it still keeps us up at night.
Yeah, I mean, like, well, this is how it is. In one of the largest lending protocol out there in the DeFi sector, so one USDC is $1 hard-coded in Compound. If Circle, like, erupts, tomorrow like collapses, then it's going to be a huge problem. We saw a small like hiccup about that in March 2023 it was, right? When SBV Bank collapsed and then USDC was trading at 91 cents or even less at some point. So oracles, for example, we update price feeds of USDC and we did report 91 cents or 92 cents. So there was no way to arbitrage with our price feeds when the protocol was using us. When like let's say Compound over the weekend, because that was happening over the weekend. That was also very.
I was up that whole weekend. Yeah.
Yeah, I was up the whole weekend as well. Like part of our treasure was in the USDC, so I was like also like, wow, this shit is hitting the fan. So that was an interesting one. So one is pricing how much of a stablecoin is worth. This is the Oracle job. The other one is to price the collateral of CDP stablecoins. So if you have, for example, MakerDAO, there's collateral against which is the stablecoin borrowed. So Oracle is usually updating the protocol about the current price of all of that collateral assets that are present out there. And the third one that also is commonly used is proof of reserves. So sometimes you have stablecoins that have reserves in various places. And not necessarily it's transparent, so Oracle can work as a kind of like a watchdog or call it auditor or whatever that attests how much reserves there are for a specific stablecoin. And in each three of those aspects, there are like risks involved. But yeah, just wanted to print the landscape.
Awesome, thank you. So we talked about smart contract risks, Oracle risks. Now, Omer, what are your thoughts on the economic risks related to stablecoin protocols?
So I'll echo what the great panel has said so far. So just like a little bit context from our vantage point of the landscape here and the risks. Chaos Labs is the leading risk platform for on-chain finance. As an extension of that, we launched Edge Protocol. And Edge Protocol has risk oracles, proof oracles, and price oracles. And really, I think what's come up from the first two panelists is that smart contract risk, oracle risk, and economic risk, they're all connected, right? So you can't kind of look at them in silo. You need to look at them holistically, and that's the perspective that we're coming in with. Yeah, and just like kind of to recap the kind of stable coins that exist today, like in the industry, or at least what's become really prevalent over the past years. We said it really quickly here. We used to have algorithmic stable coins, RIP Luna. I don't think that that's coming back for a little while. We have the CDP stable coins, which are kind of, they have an upper bound to how big they can get because they require on-chain liquidity. So I think DAI, Sky, whatever, the latest rebrand is a good one. But then you have the RWA, backed stable coins. Now I think one trend that's really interesting is that when Chaos got started 3 years ago, really most of the risks that we were doing for all of these assets were really looking at crypto native assets on chain, primarily focusing on liquidity and volatility. And for stables like USDT and USDC, besides the, I guess, like quarterly FUD that they weren't backed, there wasn't much to do, or at least that's how it felt across the industry. So if an issuer came and said, hey, I have this back office operation, we're minting stable coins, and there's one-to-one, at least one-to-one in terms of the off-chain reserve and what we have on chain, people kind of took them in face value, maybe unless like Justin Sun was involved, and then they got kind of nervous. But today, actually, you see people pushing back on that, and people want that off-chain kind of clarity, and they don't want to just deal with IOUs. So one of the big things that we're pushing for with Edge is proof of reserve oracles, and this actually integrates with their off-chain banking system, where Edge will have read access to their State Street account or whoever their custodian is, and we can in real time verify that the off-chain reserve matches at least the amount of circulating supply on-chain, which therefore also helps us price the different stablecoins. And this is, I think, really, when you speak about the biggest category, which is RWA-backed stablecoins, that is the worst nightmare, that someday you might discover that you just have all of these tokens floating on chain that you cannot redeem and that are not worth $1, and every single application or user is left holding the bag. So for us, that's the biggest economic risk, and I think it's a big design space because there doesn't really exist a methodology for how do you like properly vet proof of reserves. Nothing is really standardized. You see all of the largest issuers have their own kind of operation and best practices. So I think this is an area where things are going to grow significantly.
Awesome, awesome, thank you. So we talked about smart contract risks, Oracle risks, a little bit about economic risks. Now, Ivan, why don't you tell us a little bit about what you're building and what the industry, the stablecoin industry, has learned over the past few years in terms of some notable failures we've obviously had, as well as some of the big successes.
Sure. Glad to be here today. Glad to be seeing everyone, even though it's a bit hot outside. So what we do, we basically enable scalable crypto-native yield generation. And the obvious medium for convening this is a stablecoin, which got a great PMF and has proven that. So speaking of stablecoins and what we have learned over the last few years, well, it's obvious, but the stablecoin is stable only until it's not. That's basically what we've learned. It may sound strange, but we've seen maybe like more than 20 or 30 projects failing at the peg. If you take a look at like 23, I think there are actually more. And the fun fact is that they failed for different reasons. There are now frameworks for evaluating stablecoin stability. Sorry for the pun. S&P, for example, Standard & Poor's has one. Moody's, more crypto-native companies have those. And they basically look at different layers of risk and different angles of it. And they're different for different stablecoin designs, as highlighted. So, for example, the reason for us creating what we do was the USDC peg, similar case, right? Because you didn't feel the security of like, where I'm gonna stay to keep the value. But that's just one of the examples when the Web2 or TradFi, to be more specific, infrastructure failed at that time. But if you take a look, I can just name 4 or 5 other cases where, for example, for basis cash, the regulatory issue was the key to kind of the failure of the project. For Terra Luna, okay, or the or for other algorithmic stablecoins, there was a concern without the robustness of the design itself. Say for UXD, which was the first kind of delta neutral implementation, the counterparty risk in form of a kind of Web3 specific risk, being a risk on a DEX, was the reason for this. For example, USDR, and that's why we didn't call our stablecoin USDR. That was a stablecoin backed by real estate. The failure was because of the quality of the backing. And so you can find a reason, or you can find a lot of cases where different reasons led to the demise of a specific design. And it's really hard to evaluate. Basically, that's what led us to create a situation or create a product. We've been discussing this in a previous session, to channel the risks outside of the stablecoin, to basically segregate them away into a separate, marketable, and market-driven instrument to protect the stablecoin holders so that they don't have to kind of bother about all these layers and all this stacking of risks and how it's been actually created and what is the most important one. Is it like the backing? Is it like the market risk? Is it like the anything which is there? And I think that's what we basically need. It's still hard to tell what specific risks are there, but definitely no one wants to be the victim of the actual DPEG.
Awesome, awesome. Thanks, Ivan. In terms of progress we've made over the last 2 years, be interested to hear from any of you who want to talk about this. What do you think we've kind of changed in terms of areas we've de-risked? Like, have we de-risked on the Oracle side but increased risks on the smart contract side? How do you think risk profiles of stablecoins in general have changed over the last 2 years?
I'll add a bit here that it's interesting to take a look at the statistics of RWA-backed stablecoins versus the non-RWA backed ones? Well, if you take a look at 2021 or early 2022, I believe the non-RWA backed ones were maybe 30% of the market with the TVL of maybe 40 billion. 30 of that, something similar, was Terra Luna, unfortunately. Now, if you take a look, out of maybe 180 billion on TVL and stablecoins, only 12 billion are non-RWA backed, or basically backed by crypto. And that's quite telling. And you might say that the market is trying to get this kind of easiest path to kind of how to back it, because this risk is kind of a little bit better understandable, at least for traditional capital allocators. But I'd say that it's an important highlight that we're seeing different use cases. For the RWA-backed stablecoins like USDT and USDC, it's mostly the transactional nature of it. And for some others, and mostly for the crypto-backed ones, it's the case of enabling crypto-native investment instruments and investment products. And I believe that's what we're seeing more. And the yield-bearing stablecoins, definitely we see the increase in usage, increase in importance, and kind of the shift into this investment instrument narrative in general.
Yeah, I'll just add on to what Ivan said, that I think it's just like what's the topology like of risk, and how are we looking at different things. So for anything that's CDP backed, I think the main factor when you're thinking about listing a stablecoin, allowing it to be used as collateral or a borrowable asset, is just looking at liquidity and volatility, right? So at any given moment, you want to make sure that in case price action goes sideways or downwards, you can facilitate liquidations with slippage that's lower than the liquidation bonus. And that's what kind of V1 of DeFi looked like. But at the same time, I think it's like very clear to everyone that, even though we love decentralized stablecoins, RWA-backed stablecoins have found their product market fit. I think we recently saw it with Stripe's 1.1 billion acquisition of Bridge. And this category is just exploding. It's going way, 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 way faster than CDP-backed stablecoins that are bound by liquidity that you find on-chain. Here, I think to go back to the previous point, almost all of the risk, they're all using kind of standard, hopefully ERC-20 contracts when they're minting and issuing, and all of the risk is in the back office operation. We work with stablecoins that are minted and issued in different jurisdictions, and the processes, the guarantees that you have, are they bankruptcy remote or not, they're completely, completely different. And most people are just not aware of them, right? And in order to kind of audit it in a way that's meaningful, there's a ton of infrastructure and integrations that need to be built across the bank. So I think to kind of come back to the earlier point, the whole idea of being in Web3, at least for us, is that we have access to transparent instruments where we can understand the risk, the counterparty risk, the smart contract risk, and so on. But with these RWA-backed stablecoins, which are here to stay and are going to grow, we're really just dealing with IOUs on chain. So I think it's our responsibility, everyone who's on this panel and in the industry, to really push against that grain. It doesn't mean that we can't have them. It just means that we need to demand more transparency and have a better control over what we're letting into the protocols. And USDC was a great example of what we don't understand, right? Because only 7% of USDC's backing was an SVB. So if we had a proof of reserves oracle, we'd probably, it wouldn't make sense to price it less than 93 cents because that's what was potentially gone. But during that weekend, at least with the Chainlink oracle that Aave was using, it went down to 88 cents, right? Which meant at the time we were just, besides all of our company's treasury also being an SVB, we were looking at Aave and they were about 2 cents away from just going under complete insolvency with that price. And the question is, did it need to be like that, right? And I think that is another interesting design space besides the bank integrations, is how does proof of reserves and price oracles interplay together? So if you have, in real time, sufficient guarantees to the backing of the stablecoin, do you always want to use the secondary market liquidity? Do you always want to do that in the case also where it could mean the insolvency of the protocol, even though you're fully backed? We think to that the answer is no. It's also kind of a big question, and you need to understand what kind of risks as the manager you're willing to underwrite and the protocol is willing to take on. But that's also something I think that we're going to see changing over time. And the last thing here is that Marcin mentioned you're on 60 chains. 60 chains, the chain space is just growing and exploding, and I think one of the downstream effects of that is fragmentation of liquidity. So say you have a stablecoin like PYUSD, which is regulated by the New York Financial Department of Services. Everything is above board and being done well. But now you have kind of liquidity fragmented across all these chains, which can cause secondary market depegs really easily. Is there a reason to kind of liquidate all of the users because a whale came in and did a curve swap? Also, probably not. So we're still, like, it's clear, I think, to summarize that stablecoins, RWA-backed stablecoins have product market fit, but we're only still touching the surface of what's possible in terms of offering good UX and capital efficiency to users and protocols alike.
Does anyone from the audience know Nassim Taleb? Raise your hand. Okay, so here we
People in
go.
crypto know him, I believe.
Right, so the black swan, and this is what happened essentially with SBV, right, like going under. And just specifically to that event, should an Oracle price like 88 cents or 90 cents? This is like a very interesting question, but it's not a question rather to the Oracle itself only, but also to the users, like how they are going to respond to that, and if they have like any circuit breaker. Because on the face, you right now see that Aave was very close to going under, but on the flip side, if there was something worse happening with Circle and USDC at that time, like in the hindsight, everyone is super smart, right? So in my view, there shouldn't be an answer like either we use only market price or we use only a proof of reserve price. We should probably create like circuit breakers that are adjusted to the consumers. And then as a provider, you should articulate it very well. So hey, in the moment of the black swan happening, this is how our system is going to behave, and you should adjust yours according to that, right? So that everyone knows what happens when shit hits the fan. You're on Saturday afternoon, like with your friends, and you need to go run to your computer and like, make the system work and respond as you would like to. One thing I would like to double click over here. I'm not sure everyone heard. 90% of stablecoins, over 90% of stablecoins right now, are still fiat backed. So it's mainly Tether and USDC. Then I think the number 3 it's like DAI right now, or USDS. Etina is a very interesting design as well that is tapping into the funding rate. So basically, they're just looking at the funding rate on staked ETH or BTC, depending on which module they're using at the moment, and how to price that as well. Like we were the first Oracle that created the price feed for USDE and SUSD, like both stablecoins from Etina, and over then we had a massive discussions like which one should be like the proof of reserve. Like here also it's not as easy to create a proof of reserve, right? Because they are keeping these reserves on centralized exchanges. So you, in a sense, should also either believe the custodian if you're getting all the access to custodians because they are not so willing to give that as well, or you're believing Etina itself, like Etina team that is going to create an API or something like in that matter. What has improved, in my opinion, a lot is the discussion, because stablecoins are super important for the crypto industry, because Bitcoin, Ether, and all other coins are very fluctuating, right? Like it can go down 70% even, because like the value behind it are not like dollars, right? Like the amount of dollars in crypto and DeFi, in my opinion, is the minimum that crypto at the moment is worth, right? Because Bitcoin is very, like, it's a meme coin in a sense, right? Like there's no like, no, it is, like there is no like backing of Bitcoin. It's just the distribution and how much people believe in the value of it and how much they are going to trade and so on.
It's true for the dollar though, right? No gold standard either.
Well, there's no gold standard, but I believe there's also a critical mass point that you go through. And in Bitcoin, the biggest problem, in my opinion, from that perspective is that if things go bananas, there is literally no one you can go to. If things go bananas with the US government, like USD, like the dollar, you go to the US government, and then you can start,
And they've got an army, right? So,
sorry?
And they've got an army to handle that.
Okay, yeah, true. But the bottom line is more discussion has been held. And one thing I will leave with one question that maybe you can also address is, I was pretty excited about Liquidity V2 that is approaching right now, and Raft, Prisma. There are a couple of stablecoins, CDP stablecoins that were tapping into specifically liquid staking tokens and liquid restaking tokens. And in my opinion, the idea made a lot of sense, but all of them got hacked or didn't get like proper traction. And I believe it's still a very sound idea, like this kind of stablecoins that are backed by collateral that has on-chain yield source, but with proper like risk mitigation and analysis. But I don't know whether you agree with that.
Yeah, it makes sense to me. I think it's just the implementation and really thinking through it, and we haven't seen that done well yet.
Yeah, we worked for months with Liquidity and on the V2 mechanism design and really used kind of our simulation platform to help kind of vet the design. It's super interesting, but I think it goes back to the challenges of like DAI. That at the end of the day, there's just an upper bound to the supply that a truly decentralized stablecoin can get to. So there are use cases in which it works, and if you're like an individual user, it's probably good enough. If you're an institution seeking kind of larger positions, this is where the discussion gets different, and you probably need to, maybe you can have like a different portfolio like of stablecoins, but you're going to need to sit in RWA-backed stablecoins as well. So I think that when we speak about decentralized stablecoin, because there's no doubt for the ethos of the space that it's better, it's just the liquidity is the issue there.
And then we have not DeFi, rather on-chain finance, right? Because like it doesn't.
I don't even say DeFi anymore.
Yeah,
I just on-chain finance. Yeah.
It is.
Well, I think the one risk that has changed a lot over both the last 3 years and the last week is the regulatory risk, which is like, at first it was like, are stablecoins going to be allowed? Are we going to have to worry about the government like telling USDC to blacklist everyone in a certain jurisdiction? I think we're mostly past that. We'll have to see, but like now, like USDC is like MiCA approved in Europe, and there's going to be competition around who's regulatory compliant. But we know that it's no longer a question of like, will stablecoins exist or not? Now they will exist. It just depends on like what framework are they going to get to exist in. And on top of that, you also get to see some interesting models for like how is this going to be similar to Eurodollars, where at first the U.S. government's like, we hate Eurodollars. It like lets the dirty communists get access to dollar funding. And then eventually in a couple of decades, they were like, actually, we're going to go and extend credit lines from the Federal Reserve to Eurodollar banks. And I would be curious to see, like, in the future, if there's ever a liquidity crisis on-chain with stablecoins, if they become so critical that the Fed is like somehow extending some sort of on-chain credit line. That will be an interesting, like, turning point.
I think we're there, right? Because Tether, what are they? The 18th largest holder of short-term treasury bills in the world. And that number is only growing, and we have a new president who literally forked Aave. So I think we have some kind of early signals to what the new administration's approach is. And I think just one thing that's like really interesting about stablecoins that maybe is lesser discussed is in the macro view. Very early on, you had like a lot of these anti-crypto legislators like Elizabeth Warren, who are very much against everything that's happening in the space. But at the end of the day, there's this really interesting thesis of stablecoins as defense tech. You guys familiar with that one?
I think I've heard it.
Yeah, so I mean, the idea here is that like U.S. dollar dominance globally is at stake. With we have trillions of dollars rising in debt, and the dollar is getting weaker. And actually, stablecoins and with kind of dollar-pegged stablecoins being the main one are a way for us to kind of vampire attack other economies and strengthen the prevalence of the U.S. dollar in global economies. So I think the new administration understands that. They seem like really friendly to it, and I think also with more regulation, like we'll be able to kind of manage these things better. Because until now, everything is just best effort, right? Like you work with responsible oracles or risk managers, new stable coins, and everybody's just trying to do what they think makes the most sense. And we're going to get kind of better guidelines and clarity from the regulator as well.
Yeah, I did a bit here. Maybe like a hot take or whatever, devil's advocate. We often talk about USDC DPEG that happened, right, and how it affected everyone. Basically, we started because of this. But if you think of it, the reason for the fact that it happened was because of the, well, not as much of the regulation per se, but of the approach. Because basically Circle had no way to serve in a decent way fully the full backend, as far as I know at least. So they had to go and use basically second-tier banks, which were not that well backed in general, if basically they had the full support of the larger banks at the time. That concern wouldn't have happened because there'd be bailout, etc., etc. So in a sense, the regulatory approach to the stablecoins at that point in time created the effect which led to a DPEG. It was not actually because of the kind of ill will on the side of the Circle. It was kind of the objective reality they lived in. And that might change with the current approach. And having said that, it's basically, again, about the transparency. Nobody thought about what's back in the USDC, right? And how actually the assets been allocated and how SPV is being run, it's been like ring-fenced or whatever. But nobody knew about it, nobody thought about it, and hopefully we'll see better cases now with a better regulation. And there is a take that the main benefactor of the Trump regime is actually USDT. That's the opinion, which I've heard a while. So interesting take maybe.
All right, so we've established that Bitcoin is a meme coin, the president forked Aave, and decentralized finance is dead as we know it. Speaking of USDT, I'm going to put the panelists on the spot here. If you had to choose 3 stablecoins to hold, which ones would you hold and why?
I'd say USDC, USDT, and then USDM from Mountain Protocol if I was not a US citizen, which unfortunately I am.
And how much of which?
Checking account, USDT for checking account, because that is probably the widest acceptance in like internationally. USDC for savings, like roughly as in I'm not getting a lot of yield, but it's fairly safe. And then USDM for like basically short-term treasuries, which would be like the majority of my savings if I'm not investing it in anything else.
I would say one thing that we didn't touch upon at all in this panel and is going to be fundamental for the coming years are yield-bearing stablecoins. Because what USDT is actually doing is kind of like robbing the users of it to just put the cash into bonds or other like yield-generating products and getting. I think USDT, like Tether, has higher profit than BlackRock right now. I think it's the most cash-generating company in the whole crypto industry by far. So this is like crazy how much money the guys are generating. But the sole reason for that is people and crypto for a very long time weren't like asking for the yield on top of stablecoins. And I would say right now there's like a proliferation of a lot of companies that are doing just that. And USDM is one of the examples, but there are many others. Personally, I hold and I believe it's also a very interesting idea like the Tina stablecoin, like USDE. It has a variable yield. We are going to see how the funding rate is going to behave in stressful environment, but I believe this is a stablecoin that is worth experimenting with. I'm not saying that to put all the money over there, but I, in the long term, also believe sourcing more interesting yield generation aspects is what we should look for. Because if you are going to put the whole stablecoin industry only on T-bills, then like there's not that much innovation that we are bringing to the table. The other stablecoin is for sure SUSDS right now, which used to be called SDAI from MakerDAO, now Sky and Spark protocol, because it's a very robust system that has been live for many years and is also generating a pretty decent amount of yield. I think right now it's 6.5, and it's also available like on many chains. And of course USDC, which in my opinion is the most like secure one in terms of like a stablecoin with no yield. So that would probably my free composition.
Yeah, I'll add that definitely this yield generation stablecoins narrative is huge potentially, and specifically the fact that we need more crypto-native yield sources, because you can go and buy a T-bill basically, that's okay. The fact is that crypto has become a new type of alternative asset for traditional or conservative capital allocators, like TradFi funds, etc. And they want a new type of exposure. And you want to provide that type of exposure. That's basically a replacement of low-risk yielding instruments which are uncorrelated with the rates and with the yields in the general market. Basically, it's staking, it's the funding rates, like similar design in delta-neutral solutions, restaking, and other crypto-native sources of yield. And I believe that will become more and more and more prominent, but we haven't seen that yet, because historically, the only way to scale that was through RWA's backing. But yeah, sorry, answering the initial question, I'd say 80%, well, again, not speaking about my stablecoin, obviously, like, because it's gonna be a bias, though I have like almost everything in there in stables. I'd say now, after the Trump case, 70% USDC, 20% DAI, and 10% USDT, something like this.
I think for me, it's just a question of who's managing the portfolio and what the size is. So if you're like an Anon versus like a BlackRock, that the profile changes. Maybe if you're Anon, you can use Liquidity V2, DAI or Athena. And if you need size and you're a regulated entity, then you're going to need to sit in some RWA-backed stablecoins. And also like agree that it's an interesting trend with yield-bearing stablecoins. And I think leaders there that are basically proving the thesis out in real time are Agora and M0 and a few others that are showing. I mean, it's a pretty obvious play. But again, the main thing is liquidity and just also the redemption style. So for the RWA-backed stablecoins, like if you're willing to, if you want kind of clarity on the redemption process and guarantees and potentially insurance, and you're willing to wait a day or two in the case that you want to redeem on the weekend when the banks are closed and off-chain data is limited, then you can use a USDC or USDT versus a crypto stablecoin, which is hopefully going to be an atomic redemption or near real time.
Awesome, awesome. So in terms of yield-bearing stablecoins, this is something kind of new, kind of exciting. This is a panel on risk. So let's say, you know, my sister is excited about moving her USDT into one of these yield-bearing stablecoins like USDE from Athena or another one. How should someone like that think about the risks that they're taking and the differences in risks?
Yeah, if I may, since we build a similar idea, but we segregated the risks. That's the point that, again, it's hard to fully understand, especially for like a layman or like an average person who is not like kind of trading perps every day and doesn't know what the funding rates are, how they settle, and what is the counterparty risk and how custody works and all that stuff. Like you need some sort of providing the protection. And the usual case is that everyone is relying on the basically internalized insurance fund, right? If things go sour, the people will go there and grab it and basically will be saved. But the point is that with these types of solutions, and I'd say we raised the topic of what are the main concerns currently. Maybe one of the main concerns is transparency. I absolutely agree here. Because transparency limits, especially in these kind of hybrid solutions, like Athena or us, for example, when we can use on-chain, off-chain elements to generate yield, that's where basically it comes to understanding how well you are covered, what risks you are carrying, what's going to happen if shit hits the fan, pardon my French here. So transparency becomes the key characteristic. Because basically I can say, hey, you know what? I provide 20% yield, and it's stable. Guess what? It's actually like 10x leverage degen trading on the back end, and kind of saying that it's stable, and you don't know if it's actually true or not. You can stack as much as you wish. So transparency and reasonable risk management on that front, and well, in our case, the risk segregation into a separate instrument, are the potential solutions to address that.
I would probably go to the most regulated one as possible, like maybe BUIDL of BlackRock and Securitize, or another product that has a very much legal backing, as Omer mentioned. Like if that person is not crypto native, like she's not going to get Ethena or any primitive like that anyway. So she can either put money on Ethena and like assume it's gone, in a sense like she's not probably capable of comprehend like what are the risks involved, because we are not fully, probably, like fully. So then probably throwing the money into someone who, if there's like a bailout or like any problem, is anyhow tied to regulators and can redeem the cash, would be probably what I would go for. But one thing I also want to touch upon, you said, is new yield primitives. And I believe staking has proven to be already like a primitive, like a proper primitive for generating yield. And now it's a question of the depth, like how much of yield it can generate and for how much of the liquidity, as Omer mentioned. And I would really like to deepen that with the restaking meta over here right now, especially with USDC, because right now if you do staking, you have to go with ETH, which is like exposed to ETH fluctuations as well, on Ethereum at least. But then if you could tap into the yield coming from staking with USDC, for example, then it can be like a very interesting depth of the yield generating source.
Yeah, I'll just end and say that we talk about mainstream adoption, and I think that while we want everything to be transparent and accessible to whoever wants to take the deep dive and understand how the risk is being quantified and underwritten, it's not realistic, right? So just like in the same way in traditional finance, where most people don't understand the difference between different tranches and AAA bonds and AA bonds, I think your sister is probably really smart and can understand a lot, but you shouldn't need to. So it's the onus and the responsibility on it is on the applications and the risk managers to work together and make this accessible, but also build kind of a brand of reputation and trust, because users won't understand this. And I think that is the truth. And yeah, we need to kind of build towards that.
Yeah, sorry, I'll just add quickly that basically in TradFi, this is being solved by risk profiling. So you basically understand what is the level of proficiency of investor, how much is it okay to lose, and then you risk profile the products. We haven't seen that in DeFi yet.
Not
So
yet. But
not yet.
soon.
I'm a huge proponent of that, basically, and that's basically why we again do this, what we do, kind of the risky part, the non-risky part. We'll see more of that, and I believe that's also what was highlighted on the previous discussion. It's super important. And what's cool in crypto and on-chain, you can trace the user's history. You can understand the level of sophistication. You can understand types of instruments he used to basically better fit the products that you're offering and not kind of pushing him into this junior tranche, as was stated before, right?
Awesome. All right, I think we're out of time, so everyone please give a big hand to the panelists.